Supertrend is one of the simplest and most effective indicators for identifying trend direction and spotting potential trade entries. It overlays directly on your price chart and helps you stay aligned with market momentum using a clear, color-coded signal. But to use Supertrend effectively, you need more than just reacting to color changes. You need to understand how the indicator is calculated, how its values adapt to price and volatility, and what those shifts actually mean. In this video, part of our series The Best Trading Indicators Explained Step by Step, we'll break down Supertrend from the ground up. You'll see the full formula directly on the chart using our custom table, and we'll apply it to real-world market examples. Less noise, more signal. A step-by-step breakdown that actually makes sense. Let's begin by adding Supertrend to the chart. On TradingView, open the Indicators menu and type Supertrend in the search bar. You'll see multiple results, including community-created versions. To keep it simple, select the one listed under the Technicals category. That's the official built-in Supertrend indicator provided by TradingView. By default, Supertrend uses a 10-period ATR length and a 3x multiplier factor to calculate its signals, all based on the current chart's price and volatility. Once the indicator is added to your chart, hover over its name and click the gear icon. This opens the settings panel where you can fully customize how Supertrend behaves and appears. Now let's go over the full settings of the Supertrend indicator, starting with the Inputs tab. At the top we have ATR length. This controls how many periods are used to calculate the average true range, which defines the volatility component. The default is 10.0. Next is factor, which is the multiplier applied to the ATR to determine how far the Supertrend line sits from price. The default value is 3. Under calculation, the time frame is set to chart, meaning the indicator will follow whatever time frame you're currently viewing, whether 5 minutes, 1 hour, or daily. The checkbox. Wait for time frame closes ensures values are confirmed only after each candle closes, which helps reduce false signals. Finally, under Input Values, the option Inputs in status line lets you show or hide the indicator's parameters and real-time values at the top left of the chart. It's useful to keep this enabled for quick reference. Now let's switch to the Style tab. Here, you can customize how the Supertrend indicator appears visually on the chart. At the top, you'll see checkboxes for uptrend and downtrend. These control the visibility of the lines that represent bullish and bearish market conditions. You can enable or disable them individually depending on your preferences. Next to each option, you can customize the color, line thickness, and style. By default, uptrend is green and downtrend is red. Below that, you'll find options for uptrend background and downtrend background. Enabling these fills the chart background with subtle shading during bullish or bearish trends, making it easier to interpret trend direction at a glance. There's also a body middle checkbox, which is disabled by default. If enabled, it adds a central line that can help some traders fine-tune entry or exit zones. Under Output Values, the precision setting lets you control how many decimal places are shown for the indicator's values. The default option adjusts automatically based on the instrument and is usually the best choice. Finally, you have two additional display options. Labels on price scale adds markers on the right-hand side of the chart showing current Supertrend values. And values in status line displays the real-time values and parameters of the indicator in the top left corner for easy reference. Finally, we have the Visibility tab. This tab controls which time frames the Supertrend will appear on. You will see options for ticks, seconds, minutes, hours, days, weeks, and months. Each row lets you set the visibility range, such as from 1 to 59 minutes or from 1 to 24 hours. If a box is checked, the Supertrend will be visible when that time frame is active. If it is unchecked, the indicator will be hidden during that range. At the bottom, there is also a ranges option. This allows for more advanced visibility control, but in most cases, you will not need to use it. With all these settings adjusted, your Supertrend is now fully configured and customized. In the next step, we will look at how the Supertrend calculation actually works. Now that we've covered the default settings of the Supertrend, let's take things one step further. To help you truly understand how this indicator works, we've created a custom panel that breaks down the full Supertrend calculation directly on the chart. Instead of just showing the final result, this version displays each step in detail so you can see how the signal is built from raw price data. The first step is to calculate the average true range, or ATR. This value measures recent market volatility and is based on a user-defined period, typically 10 candles. The Supertrend uses this ATR to adjust its sensitivity and adapt to changing market conditions. Once we have the ATR, we move to step 2, calculating the basic upper and basic lower bands. These bands are derived from the average of the high and low prices, often called HL2, and then adjusted using a multiplier, known as the factor. The basic upper is HL2 plus the factor times the ATR. The basic lower is HL2 minus the factor times the ATR. These two levels form the initial framework for the trend signal. In step 3, we refine these levels based on the previous candle. If the previous close was above the prior supertrend line, the system updates the final upper by taking the maximum between the current basic upper and the previous final upper. If the previous close was below, the final lower is updated by taking the minimum between the current basic lower and the previous final lower. This filtering smooths out the line and prevents frequent whipsaws during minor price fluctuations. Step 4 is where the trend direction is defined. If the current close is above the final lower, the trend is considered up, and the supertrend line follows that lower boundary. If the close is below the final upper, the trend is considered down, and the line tracks the upper boundary instead. At the bottom of the panel, we also include a status section. It shows whether the current trend is up or down, and whether there has been a recent change in direction. This gives you a clear snapshot of what the indicator is signaling in real time. This step-by-step breakdown makes Supertrend far more transparent. Instead of just seeing a line change color, you now understand what's happening behind the scenes, how each component of the formula responds to volatility, price direction, and past data. For any trader who wants to move beyond just following signals and actually understand them, this kind of breakdown is essential. Beyond the math, let's pause for a moment and look at what the Supertrend indicator actually shows us on the chart. At its core, Supertrend is a trend-following overlay that adapts to price action based on volatility. It doesn't form a channel like other indicators. Instead, it plots a single dynamic line, either above or below price, to signal the current trend direction. When the supertrend line appears below the price, it indicates a bullish trend. When it shifts above the price, it signals a bearish trend. The change in direction only happens when price crosses the supertrend level, and that crossover becomes the core signal for many traders. But here's what makes Supertrend unique: the way it adjusts its position based on both volatility and recent price movement. The use of average true range in its calculation allows the line to automatically expand and contract depending on how active the market is. That means tighter markets result in closer stop levels, while volatile environments push the supertrend line further away, helping reduce false signals. Most traders only look for the moment the line changes color, but that's just the surface. The real insight comes from how and when those changes happen. For example, if price gradually pulls back into the super trend line but doesn't cross it, that can confirm trend strength. On the other hand, a sharp cross with strong momentum may suggest the start of a new phase entirely. So every time the super trend line shifts sides or even holds steady through volatility, it's not just a passive filter, it's a reflection of changing trend strength, volatility, and market structure. This visual simplicity is what makes Supertrend such a popular choice. With just one glance, you can immediately tell whether the market is trending or not, and whether you're trading with or against the prevailing move. Now here is something crucial, and it needs to be said clearly. One of the biggest mistakes traders make with the Supertrend is treating it like an automatic buy or sell signal. They see the line flip from red to green and rush to buy, or they see it turn red and immediately sell, without considering anything else. That's not how Supertrend is meant to be used. The line is not a magic trigger, it's a trend filter, designed to help you follow momentum, not predict the exact turning point. Using it blindly, without context, is a recipe for trouble. Many traders lose money because they oversimplify what this indicator does. They buy just because the trend turns green, even if it's already extended. They sell just because it flips red, even in the middle of a range. That's not trading with discipline, that's chasing signals. To use Supertrend effectively, you need context. You need to know the broader trend, the structure of price, and how volatility is behaving. You need to ask, is this a breakout or a fake out? Is the market trending or just chopping sideways? Let's be clear, there are powerful strategies that use Supertrend as part of a broader system. You can combine it with price action, moving averages, volume, or volatility setups. And we have separate videos that show how to do that, step by step. But that's not the goal of this video. This video is about the foundation, about understanding how Supertrend really works and the risks of using it without knowing what it's showing you. Because no matter what strategy you follow, understanding the math, the logic, and the behavior behind the indicator is not optional. It's essential. And that brings us to something we'll repeat in every video of this series, because truly understanding this one principle can change the way you trade. If you've already heard this message and it resonates with you, feel free to skip ahead. But we strongly encourage you to stick around and even replay it until you can repeat it by heart. This isn't just theory. It's the foundation of consistent, sustainable trading. Here's something every trader needs to hear, especially if you're just starting out. Indicators are not magical signals. They don't predict the future. They simply reflect what's already happened. They're tools, valuable ones, but still just tools. They help you read context, not control outcomes. The real problem begins when traders expect certainty, when they treat indicators as if they guarantee success. That mindset leads to frustration, disappointment, and an endless cycle of jumping from one strategy to another. To really understand why this happens and how to avoid it, here's a powerful reminder from Mark Douglas, one of the most respected voices in trading psychology.
You're trading on a smaller time frame and you get a little pullback right here, okay? And based on that pullback, your methodology says, okay, it's time to buy. And you do, just before this hedge fund manager comes in and starts driving the price up. See, you're going to think that the reason why you won is because that your mathematical formula told you what was happening next. And that was the reason why it happened. What I'm saying to you now is that there almost isn't any reason that you could come up with, whether you won or lost, that would correspond to what really happened in the market, other than the fact that there was an imbalance in conviction between buyers and sellers. And the reason, the people who report it in the news agencies, they don't know either. They're making it up. They make up the reasons because they sound reasonable. They are paid to sound reasonable. And there's no way to verify what it is that they say. You see, we'll put on a trade and find ourselves in a nice monster little winner here and think, oh man, my methodology, it is just fantastic. And then the next time you get the same signal and then you don't get anything. Not only that, it's a loser. You think, oh, now you feel betrayed. You think your methodology let you down. Your methodology wasn't designed to tell you what's going to happen next on a trade-by-trade basis. No technical methodology is. That's where your expectations are not in line with the reality of the situation. That's why it's so easy to make mistakes. It's because you're expecting something from your methodology that just doesn't exist. It just doesn't. It never did. Technical methodologies don't tell you what's going to happen next on a trade-by-trade basis. They will tell you what will happen over a series of trades on a percentage basis. This particular pattern will emerge X number of times, and when it does, there's a higher probability of this happening than that.
And just in case you're still holding on to the illusion of control, here's another story he shared. And it says everything you need to know about how unpredictable the market truly is.
There was a guy that came to me for consultations. He was a guy that lost a lot of people's money. He was basically what he was. He was an excellent analyst. In fact, as far as market analysis was concerned, he was probably one of the best analysts I'd ever worked with. But the problem is that as far as executing his trades, let's put it this way, he was, let's say, on the arrogant side. So he came to me for consultations, and basically after listening to him, I said, hey, you know what? Why don't you do something, get paid for something that you're good at, and and stop trying to stop losing other people's money, and go get a job as an analyst. And so he did. He got a job with one of the major clearing firms at the Chicago Board of Trade as one of their analysts for their brokers and that sort of thing. And the chairman of the board, he was an old-time grain trader, soybean trader, and made his money in the 40s and the 50s and that sort of thing, and traded pit-style trading. He didn't make direction-related trades. And so he was really mystified with the idea of technical analysis. I mean, he really was. He was literally mystified with the idea that you could basically predict prices based on chart patterns and that sort of thing. So he thought, well, you know what, I'm going to sit down with this guy and, this star analyst here that we have in the firm now and find out what this crap is all about, basically, is the way he thought about it. So he's sitting down with him for a few days, and it got to a point where one day the soybean market was basically, trading in a range, about the middle of a range between what the analysts projected as the high of the day. Not just the high of the day and the low of the day, okay? And so the market drifted around, maybe did a little bit of close to a test of the high, coming down to the low, and they're both sitting there and they're both watching it right now. And the chairman of the board says, okay, So this is going to be the low of the day right here, right? The guy said, yep, that's it. Gets that price, it's the low of the day. Low of the day. And the guy looked at him and he said, that's bull. And he picked up the phone, which had a direct line to the soybean pit. He said, sell 10 million beans at the market. Now, 10 million beans is 2,000 contracts because they trade in 5,000 bushel increments. So he hit the market at that moment with 2,000 sell orders, okay, which immediately drove the price down 10 cents on 2,000 contracts. And then after the price dropped, he looked at him and said, hey, if I can do that, anybody can do that. Now think about the implications of what I just said. Oh, gee, what if you're one of the people that bought right here? How many people did it take to mess up your trade? Just one. Just one person. That's all. It's usually more than one, but that's all it takes is one. You guys starting to get the idea? This kind of stuff is going on all of the time.
So the next time you find yourself waiting for that perfect signal, remember this. It only takes one player with enough size or conviction to completely invalidate your setup. That's why mindset matters. That's why context matters. And that's why indicators, no matter how popular, are tools, not crystal balls. And that wraps up our breakdown of this indicator. In every episode of this series, we'll keep reinforcing the same core message. Indicators don't give you an edge, how you use them does. To help you move from theory to practice, check the card above and the description below. We've linked real strategies that use this indicator in action. And if you want to keep growing, take a look at our full training programs. We've got smart money concepts to help you understand how the big players move the market. Technical analysis for day traders, focused on fast practical decision making. The Wyckoff method to help you read price and volume with structure. And most importantly, our complete trading psychology playlist, because no matter what strategy you use, mindset is what makes it work. Take the time to study. Focus on building real skill, not chasing shortcuts. Because at the end of the day, it's not the indicator that makes you profitable. It's how well you understand and use it. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro trader community right here on YouTube.